Step 8 of the accounting cycle is journalizing and posting of the closing entries. This step of the accounting cycle is focused on finalizing the accounts for the current period through the process of journalizing and posting closing entries. Closing entries are essential journal entries made at the end of the accounting period to transfer the balances of temporary accounts, such as revenues, expenses, and drawings, into permanent accounts like owner's equity. The purpose of this step is to reset the balances of temporary accounts, such as revenues, expenses, and withdrawals, to zero in preparation for the next accounting period. The process of journalizing closing entries begins with using the General Journal Book worksheet to formally record the necessary entries for closing temporary accounts. These entries are dated at the end of the accounting period, aligning with the balance sheet date. This task mirrors the process of journalizing transactions completed earlier in Step 2 of the accounting cycle. Accountants refer to the balances of the temporary accounts in the worksheet or ledger and prepare closing entries by transferring these balances into their respective permanent accounts. Here is an example of a general journal sheet used to journalize the usual transactions of an enterprise. And the adjusting entries in Step 7. Just like the adjusting entries that were written after the last transaction of the period, the closing entries shall also be written right after the last adjusting entry in the journal sheet. The next step in journalizing closing entries involves closing all revenue and expense accounts that have credit balances. This is done by transferring the credit balances from these temporary accounts to the income summary account. This process effectively clears the balances of revenue and expense accounts, preparing them to start fresh in the next accounting period. To record this, a journal entry is made where each revenue and expense account with the credit balance is debited. The corresponding credit is then applied to the income summary account. This step consolidates all revenue and expense accounts into a single account, the income summary, which will later be used to determine the net income or loss for the period. Here is an excerpt of the 10 columns worksheet that shows the adjusted trial balance and income statement pair of columns, which is one of the source document for identifying the accounts to be closed. To apply the procedure for closing revenue and expense accounts with credit balances, identify these accounts and their balances from those columns. In our sample problem, the revenue and expense accounts with credit balances that can be identified from the worksheet are sales and purchase discounts. The closing entry shall be debit to sales, 160,000, debit to purchase discounts, 3,600, and credit to income summary, 163,600. This entry resets the balances of revenue and expense accounts to zero, preparing them